In other words, the spot price of silver coming back down. Well, there's always, I've talked about support and resistance, right? So here's how that works, right? Let's say support, and you were going to buy something, like you were going to buy spot silver when it was $36 an ounce, and you didn't do it. And then it shot all the way up past 50. Well, you're going, man, if it ever gets that low again, I'm going to buy it, right? So that creates a pool of buyers at that level. And so spot goes down, dips into that pool. There are more buyers. It pushes the price up. Spot goes down, dips into that pool. It needs to use up that pool of buyers before it can go to the downside. And the reverse is true on the top, and that's called resistance. So let's say you were going to sell it at over 50. And remember, 50 was the very long-term peak in that triple cup formation on the long-term spot silver chart. I've shown you that a gazillion times. I'll show it to you another gazillion.
The 2-0-day moving average is a straightforward metric that resides beneath the volatility. Consider it as the rudder that directs a vessel through market fluctuations. Before prices are retracted by gravity, they may trend 10% above or below this average. During speculative rallies, silver, for example, may rise above this line. However, it consistently reestablishes its connection over time. The majority of asset classes adhere to the same pattern. This rhythm reveals when values are stretched and when they present an opportunity. Currently, the current market for silver is significantly above its long-term average, which is a technical indicator that a strategic entry point or correction may be imminent.
And there is this blue line that runs underneath all of these choppy lines, and that would be the 200-day moving average. So what that means is every day for 200 days, they total up where spot silver or spot gold or this is true for anything on Wall Street. Wherever the price closed, they total it up for 200 days, they divide it by 200, and it gives you an average. And that 200-day moving average, I've told you this before, but it acts like a rudder on a ship so that there's only so far above or below that average that it can go before it always comes back to that average. So here are just some examples on this long-term chart. This is a silver. Happens to be a silver chart. Okay, so you can see where these boxes are, and if you can see that blue line, there's only so far above or below that it goes before it comes back to that line, back and forth. Now, 10% away from that line is already considered a lot. So we have to keep that in mind as we move forward. But can you see what I'm talking about? And with the correction, in other words, the spot price of silver coming back down, well, there's always, I've talked about support and resistance, right? So here's how that works, right? Let's say support, and you were going to buy something, like you were going to buy spot silver when it was $36 an ounce, and you didn't do it. And then it shot all the way up past 50. Well, you're going, man, if it ever gets that low again, I'm going to buy it, right? So that creates a pool of buyers at that level. And so spot goes down, dips into that pool. There are more buyers. It pushes the price up. Spot goes down, dips into that pool. It needs to use up that pool of buyers before it can go to the downside. And the reverse is true on the top, and that's called resistance. So let's say you were going to sell it at over 50. And remember, 50 was the very long-term peak in that triple cup formation on the long-term spot silver chart. I've shown you that a gazillion times. I'll show it to you another gazillion. But that creates a pool of sellers up at that higher level. So spot goes in, dips into that pool of sellers, that pushes the price down, which is what we're seeing. That's one of the things that we're seeing right now. It goes up, it dips into that pool. When it uses up that pool of sellers, that's when it can break free and go to the other side. So we could potentially be testing that silver contract at that support level, and we'll get into it. I'm going to go to a closer chart right now. This is a 1-year chart, and you can see in this case that red line. Let's see, this is spot silver. Okay, you can see that red line is the 200-day moving average. That blue line is the 50-day moving average. When the spot price is above that 200-day moving average and the 50-day moving average, that is very, very bullish. But can you see how far stretched the spot market was from that 200-day moving average? And even going back through last night, because these graphs are from yesterday, right? I wanted to be as current as possible to show you this. It's still 22% above that 200-day moving average. So I frankly, knowing that this is a trading instrument and that it does not represent the true fundamental value of an ounce of silver, which is somewhere around $2,000, this is an opportunity to get in. Because with silver, for me personally, and you have to do whatever you're comfortable with, so I can just speak for myself. But for me personally, silver is my barterable position. So I don't really do collectible silver. I'm just looking for a variety of sizes. And in this case, I don't care if it's new. I don't care if it's old. I only really kind of care about the weight. And beyond that, it could be in any form, absolutely any form. Silver and gold at its base is monetary, so it's important to understand that. But can you see how far away we still are from that 200-day moving average? So if it corrects back down to that, if it even goes below it, I'm okay, because look at the direction of the 50-day as well as the 200-day moving average. They're in an upward trajectory, right? So remember, there's only so far above or below that it can go before it comes back to that average. So understanding the direction of that average is also really important to take note of. So this is really what's happening with spot silver. Additionally, remember, did the piece on backwardation come out yet, or is that coming out Saturday? All right. Make sure that you watch the piece on backwardation. Now, backwardation, this is true for both gold and silver, is when the current spot price is higher than the futures price. So buying silver out in the future. Because what's been happening with extreme demand is that people don't trust those future promises, and you shouldn't. We've had some entities, some large entities that usually, contracts for silver are like 5,000 ounces. They have different size contracts and they're making them smaller and smaller so you guys can participate. That's just a contract. It doesn't mean anything. But backwardation in both gold and silver is flippin' scary for LBMA or the COMEX or any entity that must deliver out that physical gold and silver, because it's very, very hard to come by the physical market, especially in the US, which is primarily a paper contract market. Don't be fooled. Take advantage of it, but don't be fooled, because they want you to stay away from it. And a lot of what's happening, and I think I saw it this morning, so I stuck a slide in there, so I'm probably going to be a little redundant on this, but in the ETFs, so SLV, GLD, have seen the largest outflow in a long time. So they saw this massive inflow pushing the price up. Now they take it out. That pushes the visible price down. But what's changed? What changed from a week ago? Absolutely nothing other than those that would have to deliver out the silver are scared because they know that the emperor has no clothes. They know that when push comes to shove, if they are forced to deliver out silver or gold that they cannot do because in the physical world there's a finite amount, then you're going to know that the emperor has no clothes. And they don't want you to know that because they want to keep this game going and stay in power. And so you'll see something kind of similar with gold, but remember that spot silver had a much more stretched run. So as you can see, when you're looking at this chart, it is still the spot silver market is still 22% away from that 200-day moving average. So if 10% away is considered a lot, then 22% would be extreme. It doesn't mean that it can't go back to extreme levels, right? Because we're seeing the same thing in all of the markets. Why? Maybe we're in the melt-up phase that I've been talking about, which is the last phase before the crash. So here's the spot gold chart, and it is still 17% above that 200-day moving average. But like spot silver, the price is currently above both the 200-day moving average and the 50-day moving average. But can you see also in this particular chart how the spot price was suppressed because it went up, and I didn't draw this line in, but it went up and hit that resistance level. People get frustrated because they think, well, nothing's happening with spot gold or spot silver at times, right? But it could just simply be working off that overbought, not overvalued. Those are two completely different things, but that overbought position. It has to do that. But also, it really is about your perception, because a rising gold price is an indication of a falling currency and also, a looming crisis. They don't want you to understand this because they need you to stay in these markets. So it's a bit of all of the above. It is a bit of working off the overbought position, not overvalued, overbought position, and it still remains technically overbought. Understand that when it's also we're in like this psychotic phase, right? Where one day everything is doom and gloom, and the trade talks and the debt levels and the defaults and this and that, and boom, there is a flight to safety into gold and silver. They want you to stay in the paper contracts. They want you to stay in ETFs. They don't want you to hold it physically. And make absolutely no mistake about it. If you own an ETF, you do not actually own physical gold and silver. All you own are shares in a trust that are designed to mimic or imitate the movement in the spot market, which does not represent the true fundamental value, 40,000 here about, and about 2,000 here. We're not even marginally near those. So you use any of these pullbacks, because let's face it, nothing goes straight up, nothing goes straight down. You always have to get bouncing along the way. And much as I know that for you watching and not really being a technician, that you like it when everything just keeps going up, and then you get nervous when there's a pullback. You need to understand, the more of this that they do, the less value that all of that money that they've already created out there has. That's the real trend, not stocks, cryptos, bonds, even gold, spot gold or silver going up. That's window dressing. The real trend is how they are devaluing the dollar. And as I've been telling you, woohoo, the devaluation trade is awesome. But what do we see? We see stocks hitting new highs ahead of the Fed rate decision. In other words, markets, corporations want the Fed, and certainly President Trump wants the Fed to lower the interest rates, which is really a cost on borrowing, a cost on this stuff, how much this stuff is worth. The reality is the lower the interest rates are, the less that value that has. Why? Because they want you to borrow and spend more. They want corporations to borrow and spend more. Why? Because that pushes more garbage fiat into the system, which then pushes the price of assets up. It also pushes the rest of the cost of living up as well. Then that makes the GDP look better, even as families are struggling to feed their families. But the GDP looks just great. This is what happens in the melt-up phase. Everything is ignored because there's just so much more of this in the system. And when they do that, that money has to go someplace, period. It just doesn't go into a vacuum. And once they create it, it's in the system, and then it's sloshing around. And it can go from this asset to this asset to this asset to that asset, driving up the visible prices of everything. But again, it doesn't matter. Look I've got this $10 trillion Zimbabwe note, and I can buy nothing with it. Because the reality is that any fiat money, its true fundamental value is zero. It is used in one place. These have never gone to zero. Why? Because they have full functionality and absolutely broadest base of demand. You decide what you want to go into this battle with. One place, every place. Give me every place. Give it to me. That's what I want. That's always what we want. So what about the physical metals? Well, the easiest place for me to show you that is through the PCGS 3000. These prices might be a little bit late, but it still gives you a really clear indication. This is the quality level that typically, and the date range that we typically use to build our sound money strategies. You can see pretty clearly, and I've shown you these charts before, you can see pretty clearly that cup formation, but we haven't broken out from the 2008 highs. However, we are still significantly below the 1989 lows. And that was when Wall Street participated. And I think it should be pretty obvious to everybody that Wall Street's starting to participate in the gold and silver markets again in a rather large way.
Spot gold and silver are still 17% and 22% above their long-term averages, respectively, despite the increasing instability. Levels that indicate speculative excess. This could be the melt-up phase, the final surge before a market reset, which is characterized by euphoria. This cycle is fueled by the relentless creation of money, skyrocketing debt, and stocks reaching record highs. However, the genuine indication of gold's value is not its price. It lies in the significance of that price. A declining currency and a decline in trust are indicative of an increase in gold. The apparent prosperity on Wall Street may in fact be the preliminary indication of a monetary tempest.